Hello and welcome to this session. Today we will discuss adjusting entries, which is part of my basic accounting bootcamp designed to teach you accounting from A to Z. In the previous session, we covered a series of transactions using debits and credits, journalizing, posting to the ledger, and most importantly, preparing a trial balance. In this session, we will build directly on that foundation. We will take the trial balance that we prepared from the prior session and prepare the appropriate adjusting entries as part of this accounting cycle. If you are unsure where the figures on the trial balance are coming from, I strongly recommend reviewing the prior recording. This is a comprehensive series of lessons that guide you through the entire accounting cycles step by step. So in this step specifically, we will be focusing on the 4 types of adjusting entries. Often this topic is challenging for accounting students. The 4 are prepaid expenses, unearned or deferred revenue, accrued expenses, accrued revenues. Now, sometimes they go by other names, but those are basically the 4. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. We will be working with this trial balance, specifically unadjusted trial balance, and we are going from unadjusted to adjusted trial balance. As I mentioned, we have 4 types of adjusting entries. 2 are considered deferrals or prepaid, same thing, deferrals or prepaid, and 2 are accrual. So, under prepaids or deferrals, we have prepaid expenses and unearned revenues. Under accruals, we have accrual expenses and accrual revenues. Now, if you know anything about Farhat, what I'm going to do now is go over each one of these adjustments separately. Prepaid 1, unearned revenue 2, accrued revenue 3, accrued expenses 4. Now, in certain textbook, they say we have 2 types, and basically the deferrals and the accrual. I like to think of them as 4 different type of adjustments. I will start with the prepaid expenses or deferred expenses. This is one of 4 adjustments, one of 4. So first you need to know, what is a prepaid? A prepaid expense is when you pay cash in advance of the expense occurring. What does that mean? It means you pay money now and you expense later. This is what we mean by prepaid. This is what it means. Expense now, prepaid later. Now, what do we expense? What can we expense? Well, we can expense all sorts of things. We could prepay insurance, then expense it later. We can prepay rent and expense it later. Supplies. When you purchase supplies is a form of prepaid. It means you pay for the supplies now and you will expense them later. Same thing with building, but building, you will see it's a different special type of prepaid. Same with equipment, special type of prepaid. You can prepay advertisement. Simply put, you can prepay any expense you would like to. So first, you pay now and you expense later. Now, when we adjust prepaid, here's what's going to happen. We have a prepaid that is an asset, some sort of a prepaid. When we adjust the prepaid, what we do is we debit the expense and we credit the prepaid. So we reduce the prepaid and we increase the expense. So whatever prepaid we have, we are going to expense it. And how do we expense it? We reduce the asset. So an asset goes down, the prepaid, and an expense goes up. That's always the adjustment for prepaid. Now, obviously, you would have some sort of a prepaid before you can adjust the prepaid. First is you purchase the prepaid. Well, so what type of prepaid accounts do we have on this trial balance? Well, let's take a look at our prepaid. We have supplies. We said supplies is a form of prepaid. We have a prepaid rent, and we have equipment. We also said equipment is a form of prepaid. And we'll see how equipment is a form of prepaid. Let me just kind of underline equipment and highlight it in a different color to tell you it's a different type of prepaid. So at the end of the period, what you do is you would look at the prepaid and you will ask the owner or the manager of this company. I see that you have on the trial balance $3,000 worth of supplies. You would ask them, do you still have $3,000? And the manager might say, or the owner of the business might say, no, we don't. I counted my supply, and the month-end count shows that supplies remaining is 500. So we're looking at supplies. So the prepaid here is supplies. And on the trial balance, we have 3,000. And when we ask the manager, how much supplies left? And the manager says, we only have 500. How did they know this? They counted the supplies. It means, as far as we are concerned with supplies, we have 500 worth of supplies. What does that mean? It means we have to book an adjusting entry. So I'm going to put the adjusting entry in blue. So the adjusting entry will be to reduce supplies enough to have 500 left. If I have 3,000, I need to go from 3,000 to 500. I need to reduce my supplies by 2,500. So I reduce my assets, supplies. And what I do is I expense my supplies expense. So the entry will be debit supplies expense, credit supplies. So an expense went up, an asset went down. This is the asset, and this is the expense. So an expense went up, an asset went down, and this is the adjusting entry. I want you to see that every adjusting entry will affect an income statement account, which is supplies expense, and a balance sheet account, which is supplies. So it affects an income statement and a balance sheet. So now we adjusted supplies. So on the next slide, I'm going to show you the adjusted balance of supplies, which will be, let me show you real quick, which will be 500. Just hold on that. I will show you the adjusted account shortly. The other account we'll be dealing with is prepaid. Now, if you remember prepaid, we prepaid $12,000 for 1 year rent on October the 15th. So we paid $12,000 October the 15th, and we recorded that $12,000 as a prepaid rent as an asset. That was October the 15th. By the end of October, October 31st, 2 weeks passed. And let's think about it. We paid $12,000 for 1 year, which is 12 months. Each month we will expense $1,000. For October, we only have half a month. Therefore, we are going to reduce prepaid by half of that. So let's take a look at this prepaid now. The prepaid here is prepaid rent. Initially, we had $12,000. Now we know we need to reduce it by how much? 500. Why 500? Because 2 weeks of rent from October 15th till October 31st is 500. So we reduce prepaid and we expense rent expense 500. Debit prepaid, credit rent expense. Therefore, the prepaid will be 11,500. That's the remaining prepaid. And the rent expense, assuming we had no rent expense except that, will be 500. Therefore, the adjustment will be debit rent expense 500, credit prepaid. So this is the adjustment. This is the adjustment. Rent expense debit, prepaid is a credit. Again, we have an income statement, the rent expense, and the prepaid rent as an asset. Let's take a look at this multiple choice question from farhatlectures.com. The adjusting entries at the end of the period will do what? That's the question. Have no effect on the financial statement, affect both the income statement and the balance sheet, affect only equity accounts on the balance sheet, reduce cash. Well, the first thing I need to tell you is this. All the adjustments that we look at, the deferrals and the accrual did not involve cash. So we did not increase or decrease cash in the adjustment. So we don't touch cash. Adjustments is basically updating the account, not cash. Cash is updating cash. We do have cash adjustments. We'll deal with that later on when we prepare a bank reconciliation. So D is out. A, have no effect on the financial statement. Do they have effect? Of course they do. They have all sorts of effect on the financial statements. If you don't prepare the adjustments, your assets are misstated, your revenues, your expenses, they do have an effect. B, affect both an income statement and a balance sheet. Is this correct about adjusting entries? And the answer is yes. And as we were going through the lecture, I was telling you, notice we have an income statement and we have a balance sheet. We have a balance sheet and an income statement. So every adjusting entry affected a balance sheet and an income statement. I would say B is correct. Affect only equity account on the balance sheet? No, it doesn't only affect revenues and expenses. It might affect revenue and a receivable. It might affect revenue and unearned revenue. It might affect an expense and a prepaid. It might affect an expense and a payable. So it affects both asset and a liability, not only equity account. That's the point we're trying to make here, not only equity account. What should you do now? Very simple. You need to go to Farhat Lectures and look at additional resources, lectures, multiple choice exercises, true, false, whatever is available for you to learn an important topic, which is adjusting entries. Whether you are studying for your CPA exam, you're an accounting student, adjusting entries are fundamental for your understanding of the exam. Invest in yourself. Good luck and stay safe.